Welcome to the Value Investor Chatter. This is the podcast that helps you grow your wealth and become financially independent. My name is Becco, and my guest and my partner, Hari. Welcome, everybody, to the podcast. I know it's been a while. We are going to be back. I know we said that a few times, but trust me, this time we are going to be back. We've made a lot of updates to our website and kind of thinking through what we're gonna make of this. Because as you guys, some of you guys might know that we've been putting out content for a little bit, for a little while now, right? 3 years, more than 3 years, something like that. And we definitely want to continue to cultivate the community, and there's so much to talk about out there. So here we go. In 2023, January 19th, we are recording our first podcast, and I think, I don't know, about a year or something like that. Maybe less.
Yep.
Anyway, good to see you, Hari. What's going on?
Well, not much. Just busy, but I think we're going to be very busy on this the podcast this year, and I think we're going to have a lot of good content. So I hope you'll join us for all of it, because I think it'll be very exciting stuff. So
awesome. So today we're going to be talking about Disney. Disney, as we talked about in the previous podcast, Disney is one of our favorites because it's a money printing gusher. But recently it has encountered some issues, and some of you guys might know the helm of Disney. There was a Bob, and then there was a new Bob, and then the old Bob is taking over. So it's a story of two Bobs. So Hari, tell us a little bit more about that.
Yeah, so for about 22 years, the original Bob, who is actually named Bob Iger, ran Disney during the end of the what was called the Disney Renaissance period, where he kind of picked up, and Disney was struggling under Michael Eisner, but they had under Michael Eisner they had made some big changes. Started making some animated movies that a lot of kids in the 80s and 90s remember, like Beauty and the Beast. It kind of ran through for about 15 years, and they made a huge progress. Bob Iger took over, and under his tenure for 22 years, there were several key acquisitions that you'll probably remember or at least have heard of, and we've talked about in the last episode, which were the main ones. There were Pixar, Marvel Studios, and Star Wars. So for each one of those, they spent somewhere around $4 to $7 billion on each, and they've integrated those, and they've made their money back multiple times over through all the licensing. And if you haven't been under a rock in the last 15 years, you've seen a ton of Marvel movies as well. But what has happened recently is, and we complained about this when we saw, was Disney's switch to streaming was going to be, their answer to Netflix and these other groups. And the problem with streaming, as we talked about when we did our Netflix episode, and because we thought, oh, Disney's going to really beat them up at the, because they have such a big back catalog. But in order to fill out their catalog, Disney spent $71 billion on buying the back catalog of Fox Searchlight. And so now Disney also controls other, brands like The Simpsons, which you can see on Disney Plus and so forth. So their argument was, we need these other assets to really gain momentum on the streaming service. So fast forward a couple of years, Bob Chapek takes over. Bob Iger kind of leaves the business as he's retiring, and kind of steps away from Disney. Chapek comes in right before the pandemic begins, and he is kind of put into a very difficult position, because he's actually not a entertainment producer guy. He was more on the Disney park side of the house. So on the Disney park side, it's a very profitable business. It's a kind of a recurring, business, but it's a very heavy asset based thing. And guy is more of a finance, kind of guy, and he's more focused on that kind of stuff. So anyway, Chapek comes in and he's under very difficult circumstances because they have to shut down production of movies. They have to turn off. So he walks into a very difficult scenario. And to his credit, I think they actually did okay there. But Chapek was really pushing heavily to get more and more invested into the streaming business. And at this time, we're starting to realize the streaming business isn't making any money. And in fact, they're doing such a poor job at it that, it's clear that, their free cash flow is taking a hit, but Chapek is like, this is not going to make money for a while because we're going to keep investing in content and so forth. So about, this time last year, there's starting to be rumors of, or I'm sorry, not last year, but 6 months ago or so, the board of Disney is starting to now get uncomfortable with where the direction of the business is. So they start moving against Chapek and start preparing for bringing back Bob Iger. And about 3 months ago, that actually occurs. And it's kind of like it's almost like tabloid news with the way you read about it in, the Wall Street Journal. He said this and he said that and blah, 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 blah. But when you actually get down to the, Chapek was kind of pushing for something that was not making money, and he'd actually irritated a lot of the content creators on the Disney side. And then there was some stuff in Florida where, Bob Chapek kind of pissed off the state of Florida, who is trying to revoke some of his special status for Disney World. So, to summarize all of this and get kind of back onto this, the biggest problems have actually occurred under Bob Iger's watch, right? He spent a ton of money acquiring things that didn't have, an appreciable return. The $71 billion on Fox being one of the biggest. But on top of that, they've spent $162 billion since 2018. So a lot of that was under Iger. A lot of it was under Chapek. In CapEx, mergers and acquisitions, and so forth, which is roughly equivalent to Disney's current market cap. So when they brought back Iger, everybody was cheering it as a huge success. But when you actually look at Bob Iger's tenure as a Disney director, they actually underperformed the S&P 500 by about 60%. So the S&P 500 went up 333% during Bob Iger's 22 years, but Disney only went up 270%. So it kind of indicates to you, like, capital allocation. We've always talked about how important it is, but this is really the crux of the argument, and that's what we're going to talk about, today, because there's going to be some activists and there's going to be some more drama that comes, into this story.
Yeah, I think that was a great summary. So I'd like to kind of focus on. I'd like to make a few comments on this. So first, I think, is the personality differences of Bob. Well, this whole thing with Bob, Chapek and Bob Iger. It's like you said. It's been kind of it's sort of like nonstop news towards the end of last year about, oh, is Bob going to take over? Is Bob's going to take over? Blah, blah. I think there was a lot of kind of Wall Street drama around this whole situation. One thing that you pointed out, I think, which is valid, which is that Bob Chapek was just simply executing the strategy that was already in place. The motion of the strategy was already in place under Iger. And then here he came and executed it according to Iger's plan. Maybe, some things here and there didn't really align with Iger's kind of, minute details, but kind of largely it was mostly set in motion when Iger was in charge. And then now here you have Iger coming back and saying, look, you're not doing a good job. I need to take over and rectify the situation. So I think that's one thing. I think we need to give Chapek a little bit more credit there. And then I think on the thing with the streaming, which we'll talk more about, is the whole idea with streaming is that you plow capital into streaming business. The whole idea behind the Disney Plus and acquiring all these different assets is that the only differentiator that they have, and I think this is true for all streaming businesses, is that ultimately you need to become a unique content provider. You can't be an aggregator like YouTube, for example. YouTube or TikTok, these are user generated content that are mostly commodity, whereas these movies are the users cannot generate them. These are high production, high value movie studios that produce them.
Yep.
And they're not commodities. So how do you differentiate YouTube category, or how do you differentiate Disney category with Netflix's? The only way to do that is by investing a lot in the content business. So I think that was a core part of the strategy. So let's go out there and actually acquire a bunch of content so that we can further our moat in becoming the sole content provider. And then the whole technology piece around streaming is commodity. It's like technology is just there to serve the business. So I think that's one thing. Another thing with streaming business is that because Disney is in a situation where they have this massive catalog of content, and they have all these different ways to monetize, right? You have one series of Marvel series or whatever, Disney series, and then you put it out there as a streaming, and then you give it out for free, basically, with the streaming business. You get them hooked, you acquire a customer, so the cost of acquisition, CAC, you basically subsidize it, but then you make it up in the back end by getting them hooked on Disney Plus, and then you go to the park and then you spend a ton of money on there, and then buy all the merchandise, blah blah. So you make it up on the back end. So if anything, this whole streaming war that's been happening, I would still think that Disney is better off than all these other providers like Netflix. How are they going to make it up on the back end? Because fundamentally, it's just not profitable. Like, you have to give it, and the customers are so used to paying $10 for unlimited content, they're not going to be able to go up. And that's why they're turning more into the ad model, which I think is a smart move, although it's questionable how the user experience is going to be with the ad model. But nonetheless, I think the point is Disney is better off than most, but still it's very difficult right now to kind of navigate this water. And I think another point that people are raising is, okay, fine, you can acquire me as a customer through Disney Plus, but then you better make sure I'm gonna pay a lot of money for the theme parks and other things, because you need to capture the value on the other side. Fine, that's no problem, but you better make sure that the quality of the experience at the theme parks and the merchandise and all these other things stay high. And I think that was another criticism of Chapek, is that, okay, you're going to raise the prices, but the quality has been going down.
Yeah.
So that I thought was a fine critique of Chapek.
Yeah, and that was certainly one of the biggest, most visible things. Was a lot of people had been accustomed to certain things at Disney parks. And then you raise the price and then reduce the service quality, right? And the biggest thing that Disney had, and this was one of the things they've written books about it, it's taught in business schools about customer service. Disney World's customer service, Disneyland's customer service was, above and beyond anything at almost any other place, right? But you weren't paying, it was essentially, you were getting the customer service you would get at like the Four Seasons, but you weren't getting the price of the Four Seasons, right? But just stepping back for a second to kind of discuss how destructive the capital allocation has been. In 2019, they spent $18 billion on content. 2020 that went up to 20 billion, then 25 billion, and then 30 billion. So they went the content spend increased 50%, in that 2-year span from 20 billion to 30 billion. But on top of that, they spent 52 billion net on, because they also sold off some of the assets when they purchased, for mergers and acquisitions to buy Fox. They got a bunch of assets like Hulu, or I think this is excluding the Hulu acquisition because they already owned some of Hulu. But when you get down to this, they spent in 4 years, spent $162 billion. And the free cash, the earnings per share actually declined from $7 a share to $3.5 a share. So think about how ridiculous that entire, like, you just set a bunch of money on fire and have nothing to show for it, right? And you can say, oh, this is under Chapek, but this, like you said, it's Bob Iger set the stage for all of this up. Chapek just continued to execute on it. He had some other ideas about the parks and raising prices and all of that stuff, but he had to do those things because they're not making money on the thing that drives people to the parks, right? And in fact, they always made money off of it before. Now you're spending money and losing it on content, so you're relying on the park to become this asset that just basically, covers up the sins of the spending here, right? So to me, this is a great business that essentially, like we said, we've always talked about Disney has a very large impenetrable moat, but the problem that we never realized is that the way that they're bringing down their moat is from the inside, right? It's not the barbarians outside the gates; it's the barbarian inside the gate that's destroying it, and that's because they're spending too much money on everything.
Yeah, I think one has to kind of wonder about. Well, I think a few things. I think one of the and you I think you did the analysis on this, Hart. So correct me if I'm wrong. One of the biggest revenue drivers for Disney was the bundling for the cables.
Yep.
Okay, so let's think about that for a second. So the cable bundle made them a lot of money, but what's happening right now? Okay, it is slowly being eroded away. You can say, though, yeah, it's still making money, fine, but it is certainly being eroded away. So as a as somebody at the helm of this giant corporation, you got to think kind of couple steps ahead. Okay, everyone's cutting cords, moving to streaming, fine. Okay, let's do the streaming strategy. Okay, so how do you think about what will be the right move there? What would be the right move in terms of cap allocation? Because another thing that we have to think about is, okay, we just went through, frankly, it feels like we went through some crazy like drug high or something with zero interest rates. Okay,
Yep.
that's one thing. That's one of the things that I'm taking away, deeply here is that as value investors, as any kind of investor, I think especially as value investor, as the macro environment deteriorates and goes to 0% interest rate, a lot of the discussions around valuation kind of goes out the window, because it doesn't matter how the company performs. It doesn't matter the fundamentals, because when the interest rate is zero, the money is free. You can just spend it all and it's no problem. The valuation is going to stay up high, no problem. And now it's coming down again. And now we're finally able to kind of be more rational about our capital allocation decision, because there is actually consequences to misallocation of capital. There is right now, 4 or 5%, right? Real consequences when you don't deploy it well. So I think that's another thing that we have to think about. And so I'll toss it back to you. What is the right strategy?
Well, so I think, I don't know all of the terms of their debt, right? But your point is very valid that when, the cost of borrowing is free, you're going to spend money. And, to give you an idea of how much they overpaid for Fox's EBIT, they paid 26.5's Fox's EBITDA for 2018. The going rate for traditional media assets was around 11.9. So they paid, and I would argue 11.9 is a lot to begin with anyway. So now Fox is $50 billion of goodwill on the balance sheet that you have almost no way to kind of monetize, right? Other than the streaming service. So the biggest challenge I think Fox is going to have, or I'm sorry, Disney is going to have, is you have a bunch of assets. I don't think you can actually sell these assets anymore to anybody at the same price. You'll probably get pennies on the dollar if you try to dump these things anywhere, right? And I don't know what to do in order to, but I think rectifying the balance sheet so that it's not going to kill you in 5 years when you have to refinance it, right? And you're now going to be paying 12% interest on it because it's, you have such a terrible balance sheet to begin with. I think that is one. Two, I think they're going to have to actually spend a lot less money on content creation, which is going to actually probably have an impact on their top line revenue. But I think what they'll have to do is start greenlighting movies and shows and things like that that are going to actually be profitable, and find ways to not put them on Disney's streaming service. Because like we were saying before, the cable business was a very profitable business because whether you watched the Disney content, Disney got paid for it, right? Every cable subscriber, I think, was paying $6 to ESPN, for ESPN, whether or not they used ESPN or, here you've now sliced that out and people are cutting the cord, moving over to streaming, but they choose whether or not they pay $10 a month for Disney's streaming service, right? So I think what they're going to have to do is probably increase the cost of Disney Plus, to something that it can cover it. I don't think the ad-based business is going to do much for them in the short term. But I think it's really going to be get people to come to the parks, because that's where you're going to make your money, and then start releasing blockbuster movies that are going to make get back to releasing 3 or 4 of those a year. Because if you look at some of the Marvel universe after the the big I forget the actual, it's been in the last 18 months, they've released a ton of movies in Marvel and they're not really making a whole lot of money off of them.
Yeah.
And TV shows, right, for that matter. So I think their biggest problem is they're going to have to figure out what are the assets that are going to make the most money, put and make content out of those, and then really cut back on everything else, because otherwise you're going to just burn cash and not going to be able to clean up the balance sheet.
So
Okay.
I'll just comment on, I'd like to just comment on that part, because I feel like this is a take that is more macro than micro. This is a take that is not just isolated to Disney, but to basically every company. And I think this is most felt in the startup space. And just going back to the macro take, because money was so cheap and they were able to finance these transactions with basically no repercussions, I think overpaying for things and not being so diligent about what they're paying for, I think those happened across the board in big companies and small companies. And there was the tendency to move out further into the risk curve, as people say, to buy things that perhaps wasn't profitable, to buy things that wasn't really, wasn't adding much value to the business because the money was so cheap. What would you do? Your money is sitting there in your bank account. You might as well deploy it, right? That was the idea. So
Yep.
Now that the macro environment is normalizing, people and business owners, big and small, have to think about, what does it mean if I deploy this capital to buy some asset? Well, in my mind, there's actually a hurdle now of 4 or 5%, because you can get that risk free with treasuries. So so I think more people are starting to rationalize costs. Obviously, CFOs all around the world is now doing cost cutting measures. So you'll see a bunch of firing announcements, a lot of rifts happening, especially in the tech industry. But it's going to spread through the entire S&P 500 and beyond. Yeah, so I think that was a good take, Ari. So tell me about this. Tell me about this hedge fund.
So, Trian Partners is a fund that is headed by a guy named Nelson Pelz, and he has made a website which you can visit called restorethemagic.com. And he has a great presentation on his website, which we've used for some of this content, to essentially say we want to make sure that as shareholders of Disney, we get the best value out of our shares, because he thinks it's still a good business. It's still um, but they need to clean up a lot of things, and they're actually not trying to replace anybody. They're just trying to get things back in order. And he thinks that their last 5 to 6 years of capital allocation have been terrible. And I don't know how you could argue that they aren't. They've been awful at it. And because of that, I think the biggest thing that I see out of this entire discussion is whether or not Trian Partners gets on the board, or whether or not I think Disney has to have a serious conversation with its shareholders and say, how are we going to fix all of the issues that we are seeing here? We've spent a ton of money. We have nothing to show for it. And we're not, we were in the last 5 years went from being a leader in a lot of different areas to being a follower in a lot of those areas, and we could do a lot better with a lot of the things that we have managed: capital allocation, leverage, all of the things that we just talked about. So I think it is interesting to see an outsider perspective come in and say, these are the problems that Disney has had. We have to fix those and reinstate the dividend and do all of the things to get people back on track. If Disney had not spent all of this money and blown out the balance sheet and done all of this stuff, I think their earnings per share would have kept growing. I think they could have actually, but Wall Street would have hammered them in the short term. But their earnings per share would look a lot better than it does today if they had continued to do that. Their streaming business is not expected to make any money for another 2 years. And even when it does, it's going to be a paltry amount of money compared to the amount they've spent on it. So, and I don't think they'll ever recoup the cost that they've spent on it at this point. So it really gets back to this point of, like, I encourage you to look at a company like Disney as, this is a great business. There's a potential turnaround here. There's a potential large, return that could be had if you were buying a Disney today. But I think it's going to take a lot of work and a lot of management effort, because they're essentially trading at the price that they traded at 10 years ago, or 8 years ago at this point. So they've lost a decade's worth of value because of this overspending.
Yeah, it's a good take. One of the things that I when I looked into it, one of the things that Chapek and Iger, I guess Chapek did, was, just to add to the point that you were mentioning, Hari, about the streaming business, and kind of the point that I was raising earlier, where streaming business is upstream, is more of a CAC, is more of a customer acquiring kind of mechanism, and you capture the value on the other end with theme parks and other things.
Yeah.
What he has done, and one of the things he has done in order to manifest this strategy, is to combine the entire organization into a single P&L. Into a single P&L. In the past, it was sort of separated out. So, okay, streaming business, you got your own P&L. Content creators, you got your own P&L. Theme parks, you got your own P&L. But if you want to drive towards the strategy of, okay, give this out for free, but you need to capture it on the back end, everyone needs to work together. Every organization within this big organization needs to be working together for the single goal of, doing really well on the P&L. Overall, on the overall company, it makes sense to group them all together. That is one of the things that Chapek did, and it's been 2 years, and I wonder what I think it's the right move if we want to push the streaming strategy, because I think you're right. Is streaming ever going to make any money? I mean, this is kind of the evergreen question with the streaming businesses. Are they ever going to make money? Like, is Netflix going to make money? Is Disney Plus ever going to make money? If that's not the case, then try to at least go for break even, or at least close the gap a little bit, and then you make it up on the back end with other things. I think that makes the most sense.
Yeah, I think the streaming business doesn't have to necessarily be blowout profitable kind of thing, but they have to. The funny thing about Disney parks is that the Disney parks, your ticket price essentially pays for all of the services that run at the park. So it's a break-even thing. Pays the salaries, it covers the capex, all of the things that they have to do to run a park. But they make their money off of people acquiring merchandise at the park. And so it's always interesting to me, like, they do all of this elaborate thing to then sell you merchandise, right? And if you continue that kind of approach with, we'll get you hooked on our content and break even on our content, but we'll find ways to sell you merchandise on top of it, that makes a lot of sense to me, right? Like, Netflix can't do that because Netflix's content is mostly targeted towards adults. We're not going to be buying, stuffed animals and things like that, based on that content, right? So I think they have to come back to a strategy of, let's stop selling things that are not going to sell ancillary products, right? Marvel, Star Wars, Pixar, the Disney animation studios, they all have a very clear path to asset, merchandise and things like that you can purchase. Everything else beyond that, to me, seems like it's not going to be, that they should be really focused on their ROI around those, 4 labels, and promoting as much of that as they can, and everything else should be kind of tossed to the wayside, because I don't think it's going to be the main revenue driver for them.
Yeah, it's good take. Any parting thoughts?
Yeah, I think this is a great example, and it is, even if you're not interested, because I don't know that this is necessarily something that most people would invest in at its current state. It's worth reading through this as an educational exercise to look at a company has taken a very profitable, very functional business, driven it into in a terrible state, and then if you follow through the next 2 or 3 years to see how do they actually fix this, I think it's worthwhile, because it'll always come down to, and it always does for value investors, what is the capital allocation? Where are they actually taking their money to then drive revenue? You spent a lot, it didn't generate anything. What are you going to do to fix it, right? And I think that's a huge part of this going forward.
Yeah, it's a great take. All right, well, this is it for us. I hope you guys enjoy the podcast. If you enjoyed the podcast, subscribe and like, and leave a comment below. And we are available in any podcast app, on Apple Podcast, Spotify, etc. So subscribe us there. And then we also have our new website. So go to valueinvestor.org, check out our new website. There should be a lot of resources for you. We publish on a weekly basis blogs about the market commentary, about what's going on. If you go to our website, you can also find a list of books that we recommend, a checklist. So as some of you guys might know, we go through a checklist when we evaluate companies. That's all free, available online at valueinvestor.org. So check us out there. All right, that's it for us.
And I'll just add one thing. If there was a lot of terms and things that we talked about today that you didn't necessarily understand, we also have a course where you can kind of go learn about all of the terms and everything about what it takes to actually make a company, financial statements, the financial ratios that we discussed, um, and also sign up for our checklist, on the website and get notified, of new content and things like that. So I think, as part of this, going forward this year, I think we're going to be putting a lot of effort into the podcast and also the website and features there to make this community even better going forward.
Awesome. Thanks, guys. And I will see you guys next week. All right. Have a good one.